Goldman Sachs has a reputation for being one of the smartest investment banks on Wall Street. It's number one in the category and in global markets. It's also the Financial Pro's third most searched investment bank over the last month on Trackstar, our proprietary stock search database. And generally, when it enters a market, it conquers it. So many thought that would happen when it entered the consumer banking business in 2016. But the firm failed to meaningfully grow revenues and is now pivoting away from that side of the business. And as the company returns to its bread and butter, is it now a good time to buy the stock? Goldman Sachs specializes in investment banking, wealth management, global markets, and asset management, and the firm ranks number one for M&A. It makes most of its revenues from global markets, with fixed income, currency, and commodities its greatest source of revenue. Goldman revenues popped from 2020 to 2021, going from $44.5 billion to $59.3 billion. The firm's 12-month trailing revenues are currently sat at $47 billion. But the firm is in a strong financial position heading into a possible recession. It has $668 billion in total cash and $511 billion in total debt. Moreover, it has a healthy current ratio of 2.47x, and it pays an annual dividend of $10 per share, and that is a yield of 2.97%. Goldman trades at a PE gap ratio of 8.9x, notably lower than its 5-year average of 11.7x. And that's better than most of its peers, but it's not as low as Citigroup or Deutsche Bank. Goldman Sachs has a price-to-sales ratio of 2.4x, and that's lower than Morgan Stanley at 2.5x and JP Morgan at 3x, but it's not as low as Citigroup and Deutsche Bank. Goldman has a net income margin of 29.3%, which tops its competitors except for JP Morgan, which is sat at 30.7%. Additionally, the company boasts an impressive return on equity of 12.2%, and while Goldman does generate free cash flow, $1.1 billion, it's not as high as its competitors. But though, things could be worse. Deutsche Bank is sat at minus $21.2 billion. In our opinion, this is a 6 out of 10 ranking stock. A weaker economy certainly hurts aspects of Goldman's business, as we've seen in its declining revenues in underwriting, asset management, and equities. Goldman shares are down nearly 12% year to date, and is trading at a relatively low PE ratio. And while we believe it's a strong company and a good stock, it's better to buy if the price dips back down to the $270 to $290 range.